Namaste to all. Welcome everyone to yet another fruitful discussion through this webinar, a panel discussion. And today's topic, after the close of the financial year, the key characteristics, the key points which one should look into while preparation and finalization of the financial statements for the financial year 22-23, and also certain Ind AS amendments related thereto. And to have the discussion on these points, we've got two eminent panelists today, CA Mohan R. Laviji, and of course CA Kaleshwar Prasadji. Both are having a great and huge experience of more than 15-20 years. Lavi sir has a bit more into AS and the Ind AS, and they have been regularly contributing to the accounting standard board in the certificate course and various other publications and webinars of the committee. So I welcome you both, Mohan sir and Kaleshwar sir, and thanks for the invite to join this and share your knowledge in this. To moderate these two stalwarts, we have got yet another stalwart, CA Rajesh Kumar Jainji, who is himself a good expert into AS and Ind AS, and he is specializing into the accounting standard and the standard analytic finalization of the financial statements. He's from Ludhiana. I welcome you, Rajesh Jainji.
Thank you, sir.
Thanks for agreeing to moderate this session. So straightforward, I'll request Rajesh Bhai to please start the session.
Thank you, sir. Thank you, Pramod sir. At the outset, I would express my sincere thanks and gratitude to CA Pramod Jainji, Chairman, Accounting Standard Board, who has given me this opportunity to share this panelists, CA Mohan L. Laviji and CA Kaleshwar Prasadji, on this important topic for the day, that is panel discussion on amendments made by the Amendment Rules 2022 and the key consideration for preparation and finalization of financial statements for the year 22-23, for which the last date is 30th of May 2023. So in this webinar, we'll be mainly focusing on the recognition and measurement principles of Ind AS. For disclosure aspects, I would request CA Pramod Jainji to organize another sessions for this disclosure aspects of Ind AS. And there are certain amendments in Ind AS which have been made by the Indian Accounting Standard Amendment Rules 2023. We'll not be discussing those topics which are not relevant for financial year 2022-3, but these will be relevant for FY 23 and 24. In this webinar, we are not going to discuss any of the amendments made by the Indian Accounting Standard Amendment Rules 2023. So we'll be starting with the first topic, with the amendments made by the Indian Accounting Standard Rules, Amendment Rules 2022, which were notified on 23rd of March 2022. And these amendments are applicable for the current year, for the year for which we are going to finalize our balance sheets in this time. I would request CA Mohan R. Laviji to take up this topic regarding amendments made by the amendment rules. Of course, I would request you to discuss only the important amendments made by these amendment rules 2022.
Thank you very much, sir. Thank you very much. And good evening. I would, of course, thank Pramod Jainji for once again inviting me to. He has got this knack for presenting these webinars at the right time, At the appropriate time, he will present the right appropriate thing. जब leasing का चाहिए तो leasing का rate डाल देंगे. जब revenue का चाहिए तो revenue का डाल देंगे. अभी तो financial statements, financial year end हो गया. Now he's put one for the considerations for the financial year end. So thank you, Rajesh Kumar ji, for giving me this opportunity also to talk about these amendments. I will just take a little bit of a general view, and then I will, get into the specific, answer the specific questions which specific question you have asked. Since this is basically, this webinar is going to target or going to look at what is going to happen for the financial statements 31st March 2023. I also, shared a little bit of information with Kaleshwar also sometime yesterday. I would encourage at the outset all the participants to look at the FRRB document, which talks about the common errors which have been made in Ind AS financial statements. This has come out in 2 volumes last year in 2022. It is a pretty, detailed sort of a presentation. We will be talking a little bit about that later on in today's session. Will not have the time to obviously cover the entire gamut of what those mistakes or errors, as we say, are there. Now, in that document, in that 2 volumes, there are some which are, I would probably call it as significant, some are important, and some are just classification and measurement problems and measurement differences. I will take you all through that a little bit later on during the session. So I would encourage at the outset all the participants who are presenting, auditors who are doing Ind AS financial statements, to have a look at the document, because it is a pretty detailed document and it does dive very deep into what are the possible errors that could crop up in preparation of financial statements and presentation of financial statements, much of which is relevant for 31st March 2023 also. Sir, as far as the Ind AS amendments 22 have been, as you rightly said, notified on the 23rd of March. Basically, there have been 6 amendments, sir. Amendments to 6 standards. The first was to Ind AS 101, which spoke about how a subsidiary can present the foreign currency translation differences. They could choose the parent's date of conversion to Ind AS and the carrying amount as per the parent. So that is only for the purpose of transition, Ind AS 101. But since most of the companies have already transitioned to Ind AS, I would assume that does not have too much of a relevance in the present context. The other amendment is on Ind AS 103, business combinations. Now, this is a pretty significant amendment. So here, what the amendment is basically trying to say, sir, is that assuming that in a business combination, assets and liabilities are acquired, they have given a specific paragraph which says that the asset and liability should meet the definition of an asset or a liability as per the framework to Ind AS. It should meet the definition of an asset or liability as per the framework to Ind AS. Now, what could possibly happen here is that, as we know, sir, Ind AS 37 says current obligation from past event is the definition of a liability. That is as per the standard. But the framework talks about an obligation. Now, say, for example, in a business combination, we have acquired a particular company. We are applying Ind AS 103. And the management has decided on a plan to, let us say, for example, let go of a set of employees or a particular business unit or a particular identified set of employees. Now, there's obviously going to be an obligation which is going to be incurred later on for that particular termination, or as you may call it, pink slip termination, whatever you may call it. The amendment says that it will not be considered to be a part of your business combination because it does not meet the definition of a liability as per the framework. So it's all the assets and liabilities which are acquired. And since Ind AS 103 talks about acquisition date fair values, it talks about acquisition date fair values. They have made a specific amendment saying that the fair value should be, the definition of an asset or liability should be met on the acquisition date. Similarly, sir, in a business combination, suppose there's a contingent liability. Again, this amendment has clarified saying that though the definition of a contingent liability as per Ind AS 37 is possible obligation from past events, it is possible that as a part of the purchase consideration, we may have to deviate away from Ind AS 37 and look at a present obligation only to account for the, if the obligation is current, we may have to account it for it as a part of the business obligation. So a sort of a deviation from the definition of a contingent liability in the amendment to Ind AS 103, only specifically at the time of acquisition accounting. Another important amendment, sir, has been made in Ind AS 16 on this one particular paragraph, which is paragraph 17, which talks about this, what are the costs which are directly attributable to a capitalization of a property, plant and equipment. Now, sir, as we know, all these directly attributable costs, and we use the word called as, we use the term called as costs incurred to bring the asset to present location and condition. costs incurred to bring the asset to present location and condition, all those costs can be capitalized. Now, an amendment has been made in this Amendment Rules 2022. It says that in case there are any sale proceeds, you're selling a part of the asset or you're disposing a part of a temporary asset which has been acquired during the course of this property, plant and equipment, the sale proceeds cannot be shown as a profit in the profit and loss account. It also has to be reduced from the cost of the asset. A specific insertion has been made in paragraph 17. So in case there is a sale during the course of acquisition of a property, plant and equipment, say for example, one particular item of asset which is not required or required only temporarily has been disposed of. Basically, they're talking about testing equipment only, basically. If that has been disposed of, not required for further economic benefits, the sale proceeds of that asset would also have to be included as a part of the carrying cost of property, plant and equipment. And that cannot be basically shown as an income in the profit and loss account. The reason for this also is because there is a certain view that it is not related to the asset, therefore it goes to my P&L account. But because of the specific insertion in paragraph 17, I think we'll have to show it as a part of the amendment, adjustment to the carrying cost of the asset only, and not a part of your profit and loss account, or directly take it to your income account. There is also a small amendment in Ind AS 109, which basically talks about exchanging of a debt instrument or a modification which has been accounted for as an extinguishment. So let us say, for example, I've got a debt instrument, and the terms of the instrument have been modified. The terms of the instrument have been modified means it amounts to an extinguishment, which means that the liability is no longer a part of my liability. Again, here the amendment is talking about any of those fees which have been paid, or any of the costs which have been incurred, or any costs which have been incurred as a part of that particular extinguishment or removal of that liability from the financial statements. Those costs should go to your P&L account. And again, there's no need for you to add it to the EIR or adjust it to the carrying cost of the asset, financial asset liability, because since the financial liability or is itself being extinguished, those costs which are a part of that or which are incurred as a part of that particular asset, they will have to be also expensed out to the P&L account. So these are the main amendments, sir. There's one on agriculture. Which talks about the fact that for the cash flows for taxation, the word called taxation has been removed. Basically, the cash flows from financing the asset in Ind AS 41, they would not form a part of the fair value is what the standard was saying. It also included the word called as taxation. So now the word called taxation has been removed, which means that they are assuming that the tax impact of that disposal would, that agricultural asset would probably also include any tax implications or tax aspects of that particular asset. So basically, to summarize, sir, 6 amendments. 101 only for presentation of the subsidiaries for the carrying amount of foreign exchange gains and losses. 103, there are 2 amendments, basically significant amendments. One is on recognition of an asset. The second is recognition of contingent liabilities. 109, I spoke about this extinguishment factor, wherein any fees which has been paid will have to be expensed to the P&L account. And 16, I spoke about the specific insertion on paragraph 17, wherein the costs which are, any sale proceeds of for inspection or any sale proceeds which have been incurred for testing of equipment which bring the asset to the present location and condition, any of the sale proceeds that will have to be reduced in the carrying amount of the asset, not taken to the P&L account. And the final part is Ind AS 41 agriculture. Word called taxation has been removed from the cash flows. So they are assuming that the cash flows would not include the fair value, would include the cash, the taxation aspects also the particular asset. So these are the main amendments.
So actually in AS 16 PP, basically they want to say that wherever there is excess of net sale proceeds from the items produced during the testing phase.
During the testing,
yes, if it is if the cost of testing is less than the cost of sale pursuit of samples produced during the period. During the period of testing, if we produce samples, definitely those samples would be sold out in the market. If the sale proceeds of the samples are more than the cost of testing, sale proceeds will be go to reduce the cost of property, plant and equipment, and not to the profit and loss.
Not to the profit. Exactly. Yeah.
Thank you. Thank you, sir. Mohan sir. Now, Kleshwar sir, I would request you to go through some major items of Ind AS presentation of financial statement. In fact, what are the complete set of financial statements as per Ind AS? And the one aspect, if there is a classification of an item of financial statement, which is to be changed from the previous financial statements, do we need to disclose the reason for reclassification, or only that one statement that we have reclassified whatever necessary that will serve the purpose?
Yeah. So namaste, sir. First of all, thanks to Accounting Standard Board for giving this opportunity. So while going through this Ind AS 1, which talks about the components of financial statements, so the beauty of it is like two elements got included in the components of financial statements. So let me cover the entire 5 components, which basically is like balance sheet, profit and loss account, statement of changes in equity, cash flow statements, notes, significant accounting policies and explanatory statement. As an explanation to explanatory statement, it says comparative information of the prior period need to be provided. So the comparative information of the previous year need to be provided. So this is a welcome thing which is getting included as a part of component of financial statements, wherein the last year comparative figures have been provided. In addition, it also talks about the requirement of a third balance sheet under following circumstances, which is basically whenever there is a reclassification, or a restatement of a financial statement, which is having a retrospective effect, or whenever you are having a retrospective application of an accounting policy. So this read with Ind AS 8 would give us a clarity. So basically, whenever we are trying to have a retrospective application, so that is the time we end up preparing a third balance sheet, which is basically the beginning period of the earlier financial period. So basically, the beginning period of the earlier financial period, wherein we are going to have it as a third balance sheet. So unlike third balance sheet, there is no need that we prepare a third profit and loss account and other things. So it's only the third balance sheet, which they have made it mandatory, so that the resultant retrospective effect can be given from the beginning of the earlier financial period. So to summarize, a component of financial statement, unlike in the earlier accounting standard regime, we have these two things. One is the comparative last year financial figure, and the third balance sheet, which is unique for Ind AS standard. So coming to the next aspect of the question, which basically says is, during the process, it may so happen that I may have to reclassify or represent the last year financial information, which is basically a comparative financial information for a better presentation of it. So basically what the standard wants is, it wants the nature and the reason of each class of items which have been reclassified or regrouped, so that the readers of the financial statements clearly understand that. There might be an instances either because we might have shifted the accounting software, or the management is not able to retrieve the information which need to be provided. Then the reason has to, they are not able to reclassify those items because they are not having that kind of a bandwidth to present the last year financial information. That information have to be clearly given. So for each class of items, whichever we are trying to reclassify, the same has to be provided in detail as an explanation in notes to accounts.
So this explanation is to be annexed to the relevant note, or separately somewhere else in the financial statements?
Toward the end of the financial statements, yes, it will be one summarized note wherein we will be saying that what are the areas, what are the nature, what are the things which we have reclassified, and what is the basis for that reclassification. That summarized amount.
Summarized. It will be better. It will not be better that in a particular note where the reclassification has happened, that in the note below that note we put that this is the nature and reasons for reclassification of an item of a financial statement, or it is to be put on the end of the financial statements only?
Sir, objective is to ensure that the readers of the financial statements understand the presentation and they're able to get a true or complete meaning out of it. So in that way, I think presenting it in a consolidated manner would help. So, however, if it is of such a significant, then in respect to the respective line items, we could also add it along with that notes.
Sure. Thank you, sir. Krishna sir, one more regarding Ind AS 7. This is statement of cash flows. In day-to-day routine, we borrow money from bankers in the shape of bank overdrafts, which is repayable on demand. Whether these are part of cash and cash equivalents for the statement of cash flows, or they has to be shown as liabilities only, secured liabilities.
Okay. So the cash and cash equivalents are basically short-term, low maturity, which is subject to insignificant risk of change in value. So where they're grouped together and presented as such. Now coming to this particular item wherein we have a overdraft, which is basically overdraft stands for for a longer duration. If it were to be a longer duration, definitely it will be outside the scope of cash and cash equivalents. But the question what you have mentioned is it's a overdraft which is repayable on demand. So you are having a scenario where the bank, if at all it demands, and you're supposed to clear that out. So this would basically fit into something called as a cash management strategy of the entity, which is evident that there will be a fluctuation. So whenever you have a surplus, you will deposit, and whenever there's a shortage, you will sort of borrow. So if it is a overdraft which is repayable on demand, that means it is very, very short duration, even though you may have the bandwidth, but it basically so happens that because of the nature, it is repayable on demand. So this gets fitted into the cash and cash equivalents. It has to be consolidated along with the cash and cash equivalents.
So, but sometimes there are cash credit limits. They are also repayable on demand. Whether these are to be considered as part of cash and cash equivalents or not.
Institute, by way of a clarification, have clarified with respect to the overdraft. If you apply the same, because basically we have to look into the terms of cash credit. What is that terms of agreement which provides for a cash credit? So if it is providing for repayable on demand and you have not given any security of such kind of a thing, then it has to be on a case-to-case basis. Mohan sir, your thoughts on this?
Yes.
You are muted, Mohan sir.
Yeah. No, Kaleshwar, I think basically you're right. Rajesh Kumar sir, there is one concept called as book overdraft.
Yes.
So there's this concept called as book overdraft. Usme, what happens there is that the entities are given a certain amount of, let me say, a facility over and above their normal, bank account balances. So they are prepared to overdraw. They are prepared to draw a little bit in excess of what they normally carry in their books, in their bank balances, right? So that will definitely be a part of your cash and cash equivalents, specifically.
That is why I'm getting a clarification from your side, because day-to-day working cash credit limits that are not part and parcel of our cash and cash equivalents.
Yeah. Correct.
Only an overdraft, short-term overdraft limit of 3 months, because
Exactly.
Overdraft limits are always given for not more than 90 days.
Exactly.
That can be considered as part of, that has to be considered as
that will be a part of cash and cash
equivalents, but not the normal cash credit limit or the working capital limits, which we say these are not part of cash and
they'll not be a part of CLC. I think Kaleshwar said also it depends on the terms also, sir.
Yeah.
Thoda agreements mein kya hota hai, they actually give you a benefit which is over and above the normal. It's not considered to be a liability sort of thing. So that may be a part of cash and cash equivalents.
But that is only cash and cash equivalent, which are day-to-day routine working of your cash flow management.
This book overdraft is a good example.
Yeah, book overdraft is a good example of this cash and cash equivalent.
Yeah.
So now, Mohan sir, moving on to the next Ind AS, that is regarding accounting policy, Ind AS 8, accounting policies, changes in accounting estimates and errors. So what are the key factors to be considered while deciding the accounting policies? First of all, let us look into only the key factors of deciding factor for the accounting policies.
Okay. So anyway, luckily you have given a disclaimer saying that we are not going to talk about the 2023 amendments. because in that
No.
there is a significant
they've
change
changed
in
the wording also.
the wording, material, significant, all that has happened. So it's a good thing we are not talking about that. So if we exclude that part from this discussion, I think Ind AS 8 is pretty clear, sir, which says that in case a specific accounting standard applies to one particular transaction, you will have to apply that particular accounting standard. I mean, for the purpose of just for the purpose of, and we know that all these Ind AS standards on whatever you're talking about, right up to Ind AS 116, have got specific areas of coverage. And also, if you look at the scope of each of these standards, I think the scope of each of these Ind AS standards also very clearly talks about what is applicable and what is not applicable. So I think that part is pretty clear as far as the individual, the scope exemptions from each and every standard is concerned. Say, for example, I'll give an example. Interest recognition, for example, for a financial instrument. They are saying you please follow Ind AS 109, don't fall back upon Ind AS 115. Effective interest rate, EIR method will have to be followed for this, interest recognition. So Ind AS 8 specifically says that when a specific Ind AS applies to a transaction, please apply that particular Ind AS. And we know that the coverage of Ind AS has been pretty comprehensive. So there are very little possibilities of transactions which are not covered by a specific Ind AS. However, the standard thinks of that also. The standard also has given an option saying that in case there is no specific Ind AS which is applicable to a transaction, the management of the entity will have to decide accounting policies which are relevant and reliable, they say. And they also go on to give some guidance, sir, on saying that you could say, for example, follow the pronouncements of the International Accounting Standards Board or any other accounting regulator. They also say that, you could, as I said, this is only going to be a theoretical possibility because we have not come across any instance wherein an Ind AS is not applicable to a transaction. But in case it does, in case we do have a situation wherein it is not applicable, they say you can go look at other guidance. Maybe pronouncements of the IASB, IFRIC announcements of the IASB could be, guidance given by the IASB could possibly be taken into account, could also be considered. They also say that you can take other regulators into account also. But I think I would probably stop at saying that since the management has got this onus of preparing accounting standards which are relevant and reliable, they would probably look at what is the most appropriate guidance for the purpose of framing these accounting policies. So this is as far as the accounting policy is concerned, sir. The change in accounting policy, I hope I'm not precluding your next question. The change in accounting policy would only come about when it is specifically required by an Ind AS. Again, Ind AS 8 says that you will, when a Ind AS specifically applies to a transaction or when the change is required by an Ind AS, as we have seen, for example, right from 115, 116, all these were examples of wherein a change in accounting policy was implemented because of this Ind AS change. Or again, they use the word saying that suppose it is more relevant and reliable, you'll have to make a change in an accounting policy. So this is basically about the change in accounting policies, sir. But very few, I do not know whether there have been any situations wherein an Ind AS has not applied, or we have situations when multiple Ind AS could apply to a transaction. Yeah. We choose only what is relevant for that. We can choose, say, for example, for security deposit. I was just discussing with Kareshwar yesterday, sir, about this. For discounting of security deposit, whether we have to show it as financial instrument or whether we have to show it as an adjustment to the ROU asset. Now, both could possibly be taken into account. The implementation guidance given by the ICA for leases says that adjusted to the ROU asset. But if I apply it on a standalone basis, my security deposit is a financial instrument as per Ind AS 32. So I would probably go by that latter logic and say that it specifically applies. So I'm going to use it as a financial instrument and not adjusted to the part of my ROU asset. But in short, sir, if it is definitely, if a particular standard is applicable, only that will have to follow.
Sometimes there is a confusion regarding whether this is a change in accounting policy or change in accounting estimate. And what are the basically difference between change in an accounting policy or change in an accounting estimate?
Estimates, as we know, are basically judgments, sir. Basically judgments like, judgments made by the management. Ind AS 8 again talks about a lot of these estimates. They talk about bad debts, provision for bad debts, they talk about obsolescence. They talk about changes in fair valuation, useful life of assets, and warranty provisions for warranty, other provisions, all these they talk about are basically changes in accounting estimates. So say for example, a fair value is probably a good example of a change in accounting estimate, because Ind AS is using this word called as fair value very, very frequently. So I thought I'll give that as an example. There can be significant changes in fair value, sir, between 2 financial years.
Yeah.
As we are seeing, there can be significant change in fair value between 2 financial years. The business model of an entity as per Ind AS 109, it could be FET-OC, it could be FET, P&L account. The business model permits you to change whatever. In case there's a change in the business model, you can choose FET P&L or FET-OC, as the case may be. But the change in the fair value, there is it could be on the upside, it could be on the downside. The change in the fair value is only a change in accounting estimate, not a change in the accounting policy as such. That would be a good example. Apart from that, even your useful life, sir, even you take the useful life of an asset. See, I have always been maintaining that, this Ind AS always says that the best person to decide what is the useful life of the asset is not the Companies Act, but, the person who bought the asset and is using the asset. The Companies Act says that the useful life will normally not be different. But if you look at the impairment standard, you look at the, Ind AS 16, the best person to decide what is the useful life should be the person who's bought the asset and using the asset. And actually, sir, when this first, amendment, Schedule 2 came in for useful lives in Companies Act, they use the word, sir, these will be the indicative useful lives. That is not there now. Luckily, now they've used the word called as will normally not be different. Indicative means it was actually a very general word. I need not take it as, indicative of my useful life there. But now they have changed the words to say it's normally not be different. So accounting policy will normally be driven by an Ind AS, sir. Accounting estimate will be driven by the management's judgment of applying that particular Ind AS. That will be the difference.
Sir, and as regarding retrospective restatement, and what is the retrospective restatement?
So I think this has already been explained by Kaleshwar when he spoke about this, presentation of financial statements. When there's a change in accounting policy, and they talk about this retrospective, restatement in Ind AS 8. When there's a retrospective restatement, you not only have to change the comparatives, but also for the earliest prior period presented. That means that, the opening of the third year, the third balance sheet factor would come into consideration there. But I would like to make one small this thing here, sir. That is basically we are talking about. This is not about prior period. It's only about change in accounting policy. I'm not talking about the prior period, which is also driven by Ind AS 8. Normally, what happens is that the transition provisions of a particular accounting standard would tell us what is to be done during transition. So, if I'm applying Ind AS 117, when it does come into play, I would probably get a transition provision saying, okay, you can adjust it to my, the reserves surplus on, let us say, 123 or 24 as the case may be. But this is not what we're talking about here. Here we're talking about an entity which has not applied an accounting policy, is applying it now. There's a change in the accounting policy. In that case, you should do a retrospective restatement and then go back to this comparatives and one earlier year presented. That's what we'll have to do.
Only the earlier year balance sheet is required, not the profit and loss.
Not the profit and loss count. Yes.
Two comparative profit and loss count, 2 comparative balance sheet, and the one balance sheet of the earlier beginning.
One third balance
sheet of the beginning of the earlier financial. Thank you, sir. Thanks so much. Kaleshwar, sir, would you like to draw some attention to Ind AS 10 events after the reporting period? Sir, sometimes there are adjusting events and then there are non-adjusting events. If there is any non-adjusting event after the reporting period, but before the signing of the financial statement, is the company required to disclose these non-adjusting events in the notes to the financial statements?
Yes, sir. So basically, Ind AS 10 on the face of it provides for few instances. So it talks one in relation to the dividend, the other in relation to material item. Let us discuss this step by step. In case of a dividend, equity dividend, which is basically proposed or which is proposed by the board of directors, which basically happens after the balance sheet date, the dividend becomes payable only on the approval by the shareholders. So the equity dividend and the dividend not provided for on cumulative preference shares. So the cumulative preference shares on which we have not provided for dividend. So these are the two dividends which will have to be provided as a notes to accounts. They're not talking about the provision. It has to be provided as an explanation in the notes to accounts so that the readers of the financial statements understand this. So this is one aspect of it. The other aspect of it is basically whenever we say it's a non-adjusting event. So there was no condition which was existed on the balance sheet date. So that is where it has become a non-adjusting event. Earlier, typically what we used to do is in case of a non-adjusting event, if it were to be so material, we used to bring it to the knowledge of the readers of financial statements. So ideally, as an explanation in the board of directors report on the approving authority would have been more appropriate. But here it says, if such non-adjusting events, if it is of so material in nature, that is, it is going to impact the economic decision-making ability of the users of financial statements, then it wants that to be covered in notes to financial statements. So it also gives few instances. Say there is a drastic fall in the value of an asset. There is a major reorganization which you have planned. Okay, discontinue of a business operation. It gives you a couple of more examples. So basically, these are of such magnitude, such materiality, even though it has happened after the balance sheet date, but till the date of approval by the board. If you exclude it, then the readers of the financial statement might not be able to get a complete picture of the financial statements. So that is where it says, out of the non-adjusting events, if it is of material in nature, which is going to impact the economic decision-making ability of the user of financial statements, those have to be included in the notes to financial statements. So basically, this is acting as an exception to the rule that we are adjusting the financial state. We are going back and adjusting the financial statements. Why I say it's an exception? Because when you say components of financial statements, notes, significant accounting policy, and explanatory statements are very much forming part of a financial statement. So we're basically going back, even though we don't touch the balance sheet and the profit and loss account, we give that explanation in the explanatory thing, saying that what are the material changes which has happened after the balance sheet date till the date of approval of the board, with a clear objective that the readers of the financial statement get a complete picture of it. So all these are basically given as an explanation and not going to impact your balance sheet or P&L account as the case may be.
So means that those events which are not definitely affecting the profit and loss or the asset side or the liability side of the balance sheet as on the date of balance sheet, but that events which affect the decision making of the users, that are to be given into the notes. If these events have occurred after the balance sheet date till the approval of the accounts by the board.
Yes, my only contention is, since notes also is a component of financial statements, so we are basically modifying the financial statements to that effect. We are making the changes in the financial statement. It is becoming more of an adjusting event.
Now we move to next, Ind AS 12, income taxes. Sir, basically there are two types of differences, that is taxable temporary differences and the deductible temporary difference. What are the key points to be kept in mind while calculating these taxable temporary differences and the deductible temporary differences?
Yes, sir. With your permission, I'll share the slide. So hope you're able to see the slide. So this is basically to ensure that the points gets communicated clearly. In relation to Ind AS 12, we basically ascertain the timing differences. Okay, we ascertain the temporary differences. Okay, and accordingly, based on whether it's a taxable temporary differences or deductible temporary differences, taxable is something which will increase your tax liability in the future. So that's where it will result in deferred tax liability. Deductible is something which is going to save your tax liability in the future. So it will definitely result in a deferred tax asset. Now, before going further, so recognizing liability, we come back to the basic prudence and conservative approach, wherein we provide that you account for all possible expenses and losses or liability, as the case may be, but don't account for gain or an asset till you have a certainty in relation to realization of it. So the same logic we can extend to even recognizing the liability, deferred tax liability and deferred tax asset, which is of notional in nature. When it comes to liability, I would rather recognize the deferred tax liability to its full extent, except a few inbuilt exceptions, which is provided in the Ind AS 12 itself, wherein it talks about initial recognition exemption. When it comes to an asset, so the definition of deferred tax asset includes the differences arising on out of deductible temporary differences, carry forward losses and tax credit. So basically, we're talking about, in addition to deductible temporary difference, we also have to take into account the brought forward business losses, the tax credit, MAT credit for that matter. Those kind of a credit also have to be taken into account. So when you are recognizing an asset, so basically you will have to see how it is going to be utilized. It can only be utilized against future sufficient tax liability. If the objective is, whenever you have a sufficient liability in the future, against that this asset or this deductible temporary differences can be reduced. So we have something called as this probability test. This probability test says that only to the extent you have sufficient taxable profit in future against which this deferred tax asset can be adjusted, only to that extent you recognize. However, while recognizing, you also take into account the possible tax planning opportunities, the taxable impact in the future, all those aspects. Say, for example, when you have a carry forward losses, that itself is an indication that the business is not making sufficient profits. So that could give you a hint as to what is going to be the profitability aspect in the future. When you're not going to have a profitability in the future, then to that extent, you can think of either deferring the recognition or bringing down the recognition of a TTA. So the same thing, I put it in a pictorial form. So whenever you're going to recognize a deferred tax asset, so ensure that you have a sufficient deferred tax liability relating to the same tax authority, because at the end of the day, I'm supposed to adjust it against the tax liability and for the same entity. So we have a holding and subsidiary company, which is basically in two tax jurisdictions. We'll have to be more careful and see that I should be able to adjust against future tax liability. That is when I will recognize. The second thing is I should have a sufficient taxable profit from the same tax authority against this TA can be reversed. The third is any tax planning opportunity, tax saving opportunity, which the entity can make use of it. So consider all this, and then only to the extent you have the probability that the deferred tax asset, the deductible temporary differences, which you're going to create it now, can be utilized or offset in the future. So only to that extent you're supposed to recognize deferred tax asset. In addition, it also provides for regularly reassessing the previously recognized DTA, as basically it is going to be an estimate, and as the time lapses, as the things progresses, management will have more and more clarity in relation to the business prospects and the probable profits in the future. So it is not just one-time exercise. You have to keep doing this year on year to ensure that if you have not recognized the deferred tax asset of earlier period because you did not have that probability positive theory, then whenever you get into that possibility that you will have a sufficient taxable profits in the future, to that extent you will recognize the TTA. And so basically it talks about reassessment of previously recognized DTA. That means whenever it is possible that it is not going to be utilized, you are supposed to reduce it. Or whenever you have not recognized it in the previous year and the scenario changes, you can re-recognize those DTA to the extent you are able to have a benefit. So this is in relation to the extent to which I can recognize DTA and DTL to that extent.
So you muted, sir.
Yeah.
I think, no.
Sheet 10.
Yes, sir.
There's no case that we cannot postpone it to the other period. this has to be evaluated at each year end or at each period end of the financial statement.
Yes.
So now for Mohan sir, moving on to this Ind AS 16 PP, which is being used for all day-to-day transactions of PPE. Sir, I would request you to highlight the key aspects of Ind AS 16, for instance, capitalization of spares, which we use in these making of PPE, the useful of definition of useful life of the assets, or the impairment of those PPE items on the financial statements.
Yes, sir. It's a pretty
long topic.
Task. It's a hot topic and it's a pretty difficult task. I can probably keep talking about this till 7 o'clock itself, but then Kareshwar will not leave me. Now will you leave me? Sir, okay. So basically, sir, what is happening now is that I will first say that again, as I have been saying for this earlier also, I will the use of the asset to determine the classification, but I'm going to restrict it only to Ind AS 16. Because see, if an asset is held for unstated future use or capital appreciation, we have to put it under Ind AS 40. If it is held for sale, we have to put it under Ind AS 105. So again, the purpose of holding the asset to determine the classification it is. Why I'm saying this is because it is important for the financial statements for 31st March 23 again. The purpose for which these financial assets, these assets are being held, would ascertain where you bracket it, whether you bracket it under Ind AS 16 PPE or they do it as Ind AS 40, which is investment property, or 105. And obviously, the purpose can change. Therefore, the classification can also change. The only thing we will have to be a little bit careful about in 105 is depreciation stops there. So that is something we have to be a little bit careful. Once we put it under 105, from that date, depreciation stops. So I think that is something which the participant should be a little bit aware of. Sir, 16 is basically a standard which talks about the property, plant and equipment which has been held for the purpose of getting economic benefits for the entity here. Since you specifically mentioned about spare parts, I will also add on servicing equipment and, these equipments are held for more than 1 year. What the standard is basically saying is that if they are been able, if these assets or if these equipment have a useful life of more than 1 year, they will have to be capitalized. They will have to be capitalized. Even though in a practical situation, they may not physically be a part of the asset. They may just be, kept as a spare part for the purpose of putting into that particular asset. Even then, because of efflux of time also, they will be depreciated. So if it is a useful life of more than 1 year, they will definitely have to be capitalized. In fact, the standard uses the word called should, sir. So there's no option there. Since they're using the word called should, I think we will have to capitalize it. They don't use the word called may. If they say may, then I have an option of expensing into P&L account. Because of the word called should, if there is a useful life of more than 1 year, which most of these spare parts could have, and I mean, it also depends upon the purpose of using those particular spare parts. The standard says it will have to be definitely capitalized. And of course, useful life, they are basically talking about the expected usage. For example, wear and tear could ascertain the useful life of the particular asset. Physical wear and tear can also be a factor. Obsolescence can be a factor for depreciation. Technological change can be a factor for determining the useful life. Technology could have changed, and thereby you may have to have a more aggressive depreciation method to be done. Sir, one more thing which I think is important in Ind AS 16, and this standard is talking about major inspection costs that can be capitalized. They also say that major inspection costs can be capitalized. Again, here we are talking about this inspection cost should invariably have some sort of a link to the economic useful life of that particular asset. I can give an example of, let us say, major inspections done, for example, airlines. Airlines will need to do a major inspection once in every 5 years, as per a mandate by the International Airports Association or that particular body. This is a very major inspection done once in 5 years for every aircraft, and the inspection gives you what is the number of air miles which that particular aircraft can fly. So it gives an airworthiness certificate, basically. It's called as an airworthiness certificate. One is that the cost of this inspection are pretty large, so significant in amount. So therefore, they will definitely have to be, capitalized. And by giving this airworthiness certificate, they are also giving us a sort of a judgment on the economic useful life of that asset. So therefore, both these factors are taken into consideration, and these costs can also be capitalized, will have to be capitalized. Recognition, very simple, sir. Initial recognition is at cost, as we know. Subsequent recognition would be at cost or at revaluation amount. Entire class of assets will have to be revalued. Option is given for subsequent recognition either at cost and or at the revalued amount, and the revaluation will have to be for entire class of assets. You can't pick and choose assets to revalue. You can't pick and choose within the class. You can't say my land in Faridabad is very, very good, so therefore I'm going to only revalue my land in Faridabad. The entire land across the country or that entire class of assets across the country would have to be also checked up, also taken for revaluation. Sir, one thing which I think we also need to know is what are the, and I think earlier also we spoke about this, costs incurred to bring the asset to present location and condition will have to be capitalized. This we have already spoken about a little bit earlier. We should also speak about what are the costs which cannot be capitalized. That also is important for us to understand. And again, the standard is giving us some specific examples. They're talking about, say for example, opening of a new plant. Those costs need not necessarily be cost to bring the asset to present location and condition. They've also spoken about, any of these expenditures have been incurred to introduce a new product or a new service. That also cannot be capitalized because, again, no link to the economic useful life of the asset, and the fact that it does not add, the economic benefits are obviously not very tangible there. So I think a good example to give can be that, now that everybody is watching the IPL because it's free of cost. If a company brings a new product and does a major advertising on IPL, just because advertisement is not free of cost, watching it is free of cost. But any major advertisement done to bring a new product, say during this IPL, you cannot say there are costs incurred to bring the asset to present location condition, or you probably cannot use the word called directly attributable costs also. So we'll have to think about what to do for that particular advertising expenditure. Rajesh sir, we may have probably thought, earlier you may know that there was a concept called as deferred revenue expenditure.
Yes.
We had that concept earlier. Now, unfortunately, it is not there.
Yes, in these, even in AS, it is not there now.
It is not there in AS also.
Yeah.
So that was a very nice concept actually. It gave us a very good, leeway to account for such costs.
In earlier years, we used to amortize it over 10 years. Then
10
we
years,
reduced it to 5 years.
Just like goodwill.
Yes.
So, this is a thing which specifically exclusion is there in this thing there. So one thing which I thought, and it's a good thing you raised this point, again, for all the participants here who are finalizing the financial statements, I'm giving just this as a note of, I won't say caution, but just take care of this particular thing. And Rajesh Kumar sir spoke about this impairment. Sir, post-COVID, according to me, there should have been a lot of impairment should have happened. But we're not seeing that much of impairment actually having been recognized, at least from what I have seen. Maybe some companies have really impaired. I know, for example, that companies like Vedanta Limited did a lot of impairment. But I'm talking about a level wherein we are talking about this entities who are not necessarily AS and not necessarily Ind AS, AS entities also. The check for impairment is extremely critical, especially in the current year, current 31st March 23. Since we are talking about a situation wherein there could be possible impairment because of COVID, because there are many assets, I do not think the economic benefits from those assets are what they used to be in the pre-COVID levels. Now, though the standard says that, okay, impairment, there are indicators of impairment, there should be internal indicators, external indicators, and all those things. My request to all the participants would be that please check for this impairment, a little bit more in detail. Because I have got a theory, sir, in this Caro reporting, your first few, questions on Caro, on fixed assets, they talk about physical verification, they talk about revaluation, they don't talk about impairment. There's no question on impairment in Caro. So what happens is that question will never be asked according to me for impairment. Because it's not there as a part of the, the questionnaire in Caro. So I think that the indicators of impairment are very clear. See, calculation is driven by this Ind AS 36. That's very clear. carrying amount is more than recoverable value. Recoverable value is higher of the fair value or value in use, which is basically your present value of your cash flows. Then there's an impairment loss. I think calculation is a very simple, not much complicated. But it's good that you raise this question, because according to me, sir, the indicators of impairment and timing of impairment is very important.
Yeah.
The recognition of the timing of impairment loss is very, very important, because Ind AS gives us the freedom that in case there are reversal of conditions, you can bring back an impairment loss apart from goodwill impairment. So it is all the more important that the timing of impairment is recognized at the appropriate time. So this is what is, and of course, there's one on government grant. Now, any government grant given for fixed assets, option is there. You can show it as income over the grant period, or Ind AS 20 has also been amended. You can reduce it from the cost of the fixed assets. This goes back to our AS treatment only, wherein you could reduce it from the cost of those fixed assets. So basically, this is what is there for Ind AS 16 property, plant and equipment. So there's only one more thing. Since we spoke a bit about the framework and said that contour of assets where economic benefits should be there, Ind AS 16 has also got a paragraph in which they have said that it is not, there could be circumstances wherein you say, for example, purchase asset for safety or environmental reasons. You don't buy the asset because you want to buy the asset. You are buying the asset because you have been mandated to buy the asset by some environment authority or the safety regulator. Here, there is no direct economic benefit, obviously, because you're actually purchasing this asset for the purpose of meeting and complying with the law. But Ind AS 16 is very, very clear. Even those assets can be capitalized, should be capitalized, even though there is no direct economic benefit which is available for the SSC. So these are the significant points of Ind AS 16, sir.
Sir, as regards what you talked about, the value and use, if the company is continuously running into losses, and then the value of use has to be calculated at every period end.
Absolutely, absolutely.
Because that will be give us a very clear indication of impairment of the property, plant and equipment.
It's a very, very appropriate point made by you, sir. Because agar bahut loss hai to kahan pe cash flow kahan pe aayega DCF ke liye?
Cash flow will not be there, and definitely the value of use will be
your
very
VIU will go for a toss. Definitely, your VIU will be impacted. Definitely, yes.
If the unit is running into good profits, then the definitely value of use will be very, very much higher than the carrying cost.
Correct.
Then carrying cost, then there will be no impairment of the property, plant and equipment.
Sir, if the unit is profitable, it's only your Excel skills which are important for VIU. That's all.
Yeah.
How good you are in Excel, that's all is important for VIU. But you're right, because if it is under losses, the calculation of VIU itself may become very difficult.
Yeah. Means you cannot, value of use, you cannot increase that. You cannot put that will be earning profits in the future.
Yeah, 5%, 10% growth, all that you cannot put it up.
Thank you, sir. Thank you, sir. Now I would move to this Ind AS 19 implied benefits. So there is always a confusion that whether the director's sitting fees or the leave encashment which we pay to the employees, whether it is a part of implied benefits.
I wish I could give a very authoritative answer on that, but unfortunately I cannot. Sir, if you look at paragraph 7 in Ind AS 19, it says that the standard is applicable even to directors. Yeah. The paragraph 7 has got a very clear insertion saying that it is applicable to directors of the company also. It was, it's a very clear reference to any of the amounts which are paid to directors. And I would assume that the sitting fees or any other fees paid to directors would be a short-term employee benefit.
Yeah.
If I apply it with the paragraph 7 and the short-term employee benefit, I would say it is applicable. Definitely it's applicable. So, I mean, obviously you'll have to make a provision for it and all those things, but that is driven by the standard, not necessarily, out of Ind AS 19. You'll have to definitely follow it, because I would only go by this one paragraph. It says that it is applicable to any payments. We are talking about sitting fees in particular, but they could be, say, for example, commission paid to directors. What happens in that particular case? Again, it could be a short-term employee benefit. It could be a profit-sharing bonus. Any of these things with a short-term employee benefits, I would think that we would have to follow Ind AS 19 definitely. Of course, there will also be a disclosure from related parties, but that is out of the today's topic, so we'll not worry about that aspect. Then this leave encashment, I'll only have to give you a 50-50 answer because standard does not specifically say actual valuation is required. They say estimate has to be made only. They do not speak about this PCU method for leave encashment in general. They only talk about it for the defined benefit plan, which is basically your gratuity plan. Which is basically for your gratuity. So if you look at the sequencing of the standard, I will stick my neck out and say that we can probably make an estimate for leave encashment, need not necessarily have to follow actual valuation. However, having said that, it is better to err on the side of caution and say that, okay, I'll get an actual valuation any which ways.
Sir, even SEBI has some always want to have information on the payments made to the directors.
Exactly.
Yeah. Every quarter or 6 months, we file the statement with the SEBI.
You're right.
All the commissions or profit sharing or the director sitting fees is covered. That means any short-term employee benefits which we pay to the directors should be covered under employee benefits.
Should be covered under 19. Absolutely. Yeah.
Thank you, sir. Kleshwar sir, now moving on to Ind AS 20. This again is very, very important topic because in these days there are a number of grants which are coming forward towards the entities. What is the difference in government grants and government assistance? Because sometimes there is a thin line between government grant and the government assistance.
Yes, sir. So in fact, we can draw a thing out of the Accounting Standard 20 thing itself. What it says is Accounting Standard Ind AS 20 talks about treatment of government grants and disclosure of government assistance. So basically, what it is trying to say is, so even though disclosure would be required even for the government grant, but it is mainly targeting the disclosure of government assistance. So in a very simplistic language, if I have to tell you, anything which has a monetary value, whether it's a monetary or a non-monetary item, if you are able to establish a value for it, then it falls into the grant category. Okay. So non-monetary item, it should not be difficult for us because of the fair value measurement. We should be able to ascertain a value and accordingly give a value and recognize it as a government grant. Anything which does not have a monetary value or where we are having a difficulty to ascertain the value for it, that could fit into an assistance. Say, for example, government has started a public transport basically to facilitate movement of employees of the organization. So that could be a assistance where you are not able to establish it. Yeah. Then it has put a road for a rural area where your factory premises have been located, or it has given you a moral support sort of guidance and those kind of a thing. It could also be like giving you a free access to market where you will be enrolled and you will be able to buy and sell goods. So these are some of the things where you will be able to get a benefit, but it would be very, very difficult to assign a value to it. So it has only qualitative characteristics, but does not have a quantitative characteristics. So if it has a quantitative characteristics, then we would have established a value, and accordingly with one or the other method, we would have ascertained a value, and then we went on to see how to recognize it in the balance sheet or a P&L account as the case may be. Since it has only a qualitative characteristics, we end up disclosing what is that government assistance, in what methodology we will be able to get a benefit out of this government assistance. So that will be more of a disclosure related aspect than of recognition and a measurement.
For government grants, we have to recognize and disclose.
Yes.
And for the government assistance, only disclosure of those government assistance without any value, because we can't put any value into those benefits derived out of the government programs or policies. That means only the disclosure of whatever assistance we have got from the government is to be made in the financial statement.
Yes.
Sir, in this standard, there is a one question: how to account for these government grants received against import of spare parts under the Export Promotion Credit Guarantee Scheme?
Okay, if I remember, I think Institute in one of its clarification bulletin had clarified on this. So I don't readily recall what is that bulletin.
That was mainly on account of EPCG scheme for capital goods.
Okay, thanks for pointing it out.
Yeah.
So again, it depends on when you are getting that benefit. So what is that objective with which you are getting the benefit? Is that objective is basically to subsidize the value of an asset, or is it basically to facilitate? So once you have a machinery, you basically have to produce and sort of generate and export earnings and those kind of a thing. So basically, you'll have to go and check what is the principal benefit or objective with which that particular that benefit you are getting. So accordingly, if the principal objective for is to reduce the cost of an asset, then you better recognize it as in proportion to the charge of an asset to the P&L account. So ideally, depreciation would have been in ideal instances, based on which I would have recognized the corresponding related benefit to the P&L account. If it were to be in relation to promoting the exports, so that would become the basis for me to recognize the related benefit over the P&L account over a period of time.
Sir, if a government grant becomes repayable, sometimes we have to repay back to the government in case we do not fulfill the condition attached to that government grant, fully or partially. Do the company need to identify this repayment as a change in accounting estimate or something else?
In fact, the standard itself provides that at the time of recognition of a government grant, in case, so if you have uncertainty, definitely you will defer recognition of it. But it also talks about Ind AS 37. It also talks about making an adequate provision for non-receipt or a repayment of it. And it clearly says, read with Ind AS 37, it clearly says that whenever there is an instances where you have recognized the government grant, and for whatever reason, either for non-fulfillment of a condition or any other reason where you end up into a scenario of repaying the government grant back, it would be accounted only as a change in accounting estimate. So it will have only a prospective effect. It depends on like what methodology you have been following. If you have an unaccrued, where you still have an accumulated balance, so first you will recognize, reduce that from that balance, and only the balance you will transfer it to P&L account. To answer, it would only be recognized as a change in accounting estimate. So there is no retrospective restatement or a retrospective adjustment required for the earlier period financial statements.
Because sometimes we cannot foresee that we won't be able to comply with the terms and conditions of the government grant. If we happens that we have not complied with that condition, then we have to refund this amount. But that condition becomes applicable to us only when we are not able to fulfill that condition. That means it is not a change in an accounting policy, it is a change in an accounting estimate only.
Definitely. Even there, while estimating a provision and those kind of things, it says that you have to consider those factors and accordingly make a provision to the extent required. And if at all you have to repay that money, then it has to be by way of a change in accounting estimates.
Thank you, sir. Mohan sir, I would now move on to Ind AS 21, the changes in foreign exchange rates. So, what is the functional currency and what is the difference between functional currency and the presentation currency?
Yes, sir. So, functional currency is standard itself defines it as the currency in which the major economic transactions of the entity in the economic environment of that entity is being conducted. So, it would be driven by what currency is being used for, say, for example, for purchases, sales, borrowings of the economic environment. The country also would be a part of this particular thing. So that is what will drive your functional currency. Presentation currency is fairly simple, sir. And, you could have a requirement wherein standards by a regulator say that you have to present in a particular manner or a particular currency. So that would be the currency in which the financial statements are going to be presented. There it can be different. It is possible that there can be a difference between the functional currency and the presentation currency. It's possible that it can be different also. Say, for example, I mean, we always take the example of Indian rupee, but if you go to a country like, say, for example, Venezuela, which incidentally, sir, is also following this Ind AS 29 on hyperinflationary economy, because they've got more than 100% inflation for the past 3 years. So what is happening there is that the Venezuelan currency is no longer valid. They've all shifted to US dollars. The entire country has shifted to US dollar now. So the functional currency of Venezuela has become the US dollar itself. The presentation currency can probably be that Venezuelan, whatever that currency is. But the functional currency is the US dollar, because transactions of purchase, sale, everything is happening in US dollars.
Okay, sir. Sir, how to account for the exchange differences in monetary and non-monetary items? And more particularly, whether the advances to suppliers or advances from customers is a monetary or non-monetary item?
Okay. It's good that you raise this question again, sir, because I think this entire weight of Ind AS 21 is on classification of monetary and non-monetary. The accounting treatment is driven only by monetary or
monetary.
So monetary items means, okay, initial recognition on the transaction date, exchange value on the transaction date. Subsequent measurement, they say at the closing rate. That is for the monetary transaction. For non-monetary, they say that if it is at cost on the date on which that transaction was entered into, if it is at fair value on the date of fair value measurement, for subsequent measurement for non-monetary item. You specifically asked about advances from customers, advances to suppliers. Again, if you look at the examples given in Ind AS 21, unfortunately, we've given by the foreign examples only. We don't have any Indian examples. We don't have, say, for example, security deposit as an example, as you said rightly, advances which have been, refundable in cash. Those sort of advances are not given as examples here. But if you look at the definition of a monetary item, sir, any of these items which can be converted into cash or cash equivalents in a reasonable frame of in a reasonable time. That's what is basically the definition of monetary. So I would say that advances would probably come under monetary only. Advances would probably come under monetary only because of the fact that it can be converted, and of course the transactions, it depends on the short term, long term, that also would play a factor in this. But I would assume that if it's long term, then we have a little bit of a problem as to how to classify it. If it is short term, I would definitely say it is a monetary item.
But sir, these advances to suppliers or advances for customers, these are not to be given converted into cash or cash equivalent.
It will be settled
by way of supply, either inward supply or outward supply.
Correct.
Then I think whether it will be it's non-monetary item.
In that case, non-monetary, yes.
Because none of the advances to suppliers or advances from customers are adjusted by way of cash settlement.
It will never be settled in cash. Yeah, correct. I stand corrected. If that is the situation, then definitely it will be non-monetary.
I was asking that question from that perspective.
No. Then it's definitely non-monetary.
Because all the advances to suppliers or advances from customers are mostly not settled through cash. If it is to be settled through cash, then definitely it is a monetary item.
So that is how you distinguish between trade receivables and advances, basically. Yeah. Trade receivables will ultimately be settled in cash, right?
Yes, that is a monetary item, but advance from customers are definitely non-monetary item if it is are to be settled through supply of goods.
Exactly. Or rendering of services, that's the case.
Yes, it could be. Thank you, sir. Now, Kaleshwar sir, moving on to this also very, very important Ind AS 23 borrowing costs. So sometimes there is general borrowing which is used for eligible for capitalization, and there is some difficulty in identifying borrowing costs. What are the remedies available to the company as well as the auditors who are auditing those financial statements when the general borrowing or the common borrowings are used for capitalization?
Yes, sir. So basically, when we are talking about borrowing cost, we're basically talking about capitalization of interest and related cost. Instead of transferring it to P&L account, we basically charge it to or capitalize, add it to the value of an asset. So it is sort of, there should be a direct relationship between the interest and the cost and to the asset. That is when you will be able to capitalize instead of transferring it to profit and loss account. So there has to be a borrowing cost incurred, and that cost incurred in relation to qualifying asset, and you are able to establish a relationship between expenses and the asset in relation to which you have spent. Then only you can capitalize it. The standard gives you certain example wherein it says whenever you have a difficulty. So the difficulty is like instead of the particular branch or a vertical, it is the loan is processed at the center level and they make it available to the respective branches for procuring an asset. Or I have procured a loan and there are too many fluctuations in foreign currency. Or the third scenario would be I operate in a highly inflammatory economy. So you can take that same example as Mohan sir just pointed out. So in this case, it might be difficult for us to basically establish a relationship between the cost and the asset. If it's an highly inflammatory economy or because of huge fluctuation in forex, you may not be able to establish a nexus between the cost and the asset. So this is where the judgment of the management comes into picture. Management have to invoke, they will have to justify, they will have to do an estimate and say what extent would be in relation to the asset, what could be the one which would not be in relation to asset, and that's how it will go to the profit and loss account. So it is basically like the management judgment, what is important in ascertaining what portion to be capitalized and what portion to go to P&L account. Now, as an auditor, we will have to audit the basis on which management were able to estimate, management were able to come to a decision. If it is reasonable, the estimate what they have made is reasonable, then we can go with them. If we don't agree to that, then the other course to follow. So it is basically whenever this kind of a difficulty happens, the management has to take a judgment, has to make a judgment, and accordingly has to decide what portion has to get capitalized and what portion can be charged to the profit and loss account.
But in that case, should we made appropriate disclosures in the financial statements, the basis on which we have capitalized the borrowing cost?
Definitely, sir. So especially whenever there is a judgment and an estimate, you are supposed to say what is the basis for them to arrive at this kind of an estimate, and accordingly that reasonableness have to be explained in notes to accounts.
Because if it is a general, if it is a specific borrowing, then there is no difficulty in arriving at the borrowing cost. But if it is a general borrowing or the borrowing is centralized in the head office, and then I think the disclosure should be made on the which basis the management has capitalized the borrowing cost.
Yes, whenever we have a difficulty to establish a nexus, so this judgment comes into picture, and the basis of the judgment need to be suitably explained so that the readers of financial statement gets a meaning of it.
Thank you, sir.
Thank you.
So Mohan sir, this sometimes we do prepare interim financial reporting, like on the basis of Ind AS 34. What are the significant events or transactions that must be disclosed account for in the interim financial reporting as per Ind AS 34?
Yes, sir. Again, this is a standard which is pretty important from the point of view of, considering also that it has got a link with, as you have mentioned earlier, about SEBI requirements also. So there is a little bit of an interplay between what 34 is talking about and what, SEBI also requires here. Of course, 34 is very clearly saying that all the Ind ASs will have to be followed for the purpose of accounting, sir. So you have to follow. There's no exception from following any Ind AS for the purpose of recognition, measurement, and all the Ind ASs will have to be followed. The most important paragraph probably in 34, as you have asked, is basically about what has to be disclosed, because basically between 2 quarters, many things could have happened in an enterprise. And the reader of the financial statements is supposed to know what are those significant events which have, occurred there, so that he is able to pass or he is able to take a necessary judgment on what has happened there. Now, here, the standard again gives us a lot of examples. It talks about, say, for example, acquisition and disposal of PP. It talks about business combinations. It talks about impairment of, assets. It talks about many of those factors for either significant impairment of asset. Restructuring costs or costs which have been, which have been reversed during the particular quarter or during the particular interim reporting financial period. Any litigation which has been settled, all these things, again, prior period errors, even prior period errors which have been discovered during the quarter. Again, if there's a restatement required as per Ind AS 8, that disclosure also is required. It could also enter into a major business combination. These factors, specific disclosure is required from the point of view of Ind AS 34. But however, sir, having said that, I think that these are only examples which are samples. They are only representative examples. I mean, they may not necessarily get into a situation wherein, say, for example, there's a major inventory write-down in a particular enterprise. If there's a major inventory write-down in a particular enterprise, which has probably not happened in the past before at all, but happened in the March 23 quarter. The management will have to take a call whether it's significant enough to be called as an interim. I mean, when they present the interim financial statements for March or June, whenever they present it, whether that as an event itself, the inventory obsolescence or write-down of inventory, whether it is a significant event, you forget about Ind AS 2 for a moment, whether it has to be disclosed in the first place. But I will step a little bit away from Ind AS, I mean, what the examples given by the standard, sir, and say that, see, basically what the standard is talking about or examples given are for which there's a particular Ind AS applicable. They spoke about 103, they spoke about reversal of provisions, they spoke about impairment, they spoke about obsolescence, all have been covered by, some other standard. So definitely, if there's anything which is significant in material value, which could affect the decisions made by the use of the financial statements, that will definitely have to be disclosed. But I would also try to probably say that if you look at the intent of the standard, it need not necessarily be only an item which is pertinent to a financial transaction, sir. It may not necessarily be pertinent to a financial transaction. Say, for example, there's been a very significant change in the management, or there has been a very significant change in the, one particular, let's say, for example, KMP or CEO, whoever it is, right? In the normal course, they would say that they'll give a disclosure as a corporate governance measure. Many companies would say that as a part of my corporate governance requirements, I'll probably give this disclosure. But I would think that if I look at the intent of 34, I would probably say even these non-monetary or non-Ind AS related events could also be significant events which require a disclosure. So I would probably break up the disclosure requirements in 34 into two categories. One is what has impacted the financials. What has impacted the financials significantly? Again, significantly is a very guarded and loaded word, so we will keep it open-ended there. What has impacted the financial statements significantly? It could be any of the things which I spoke about. It could be a business combination, major loss, restructuring loss, write-down, litigation settlement, major litigation which entity has got into during the particular quarter. Any of these things having a financial impact could be significant. That is from the financial point of view. I would also think that any other non-financial related matters which impact, say, for example, the way the people would view an enterprise, that would also have to be disclosed. So I would split it into two, and both these disclosures would be required.
So SEBI requirements are very, very less. They have a specific format for disclosure in the quarterly financial results, which we publish on quarterly basis. But the set from which those results have been derived out, that is as per Ind AS 34.
34, correct.
We have to, that means we have to recognize and measure according to the relevant standard. But only the disclosure standards are different for the Ind AS 34. SEBI require only the financial part and some notes on accounts.
Notes on accounts, correct.
That not only all notes on accounts, only the very significant notes on account, which So, and another small information regarding Ind AS 38, intangible assets, accounting treatment for operators' right over infrastructure in case of service concession agreement. Please elaborate or give it a brief about it.
Okay, so I think this is again, it's good that you raise this question now instead of at 115 stage, because 115 has only got a portion of it here. Sir, again, here you see that the accounting treatment would basically be driven by the agreement, right? Now, many of these agreements, and especially in the Indian context, I think this becomes very, very important because many of these infra projects are coming up under various modes. They've got something called as hybrid annuity model, HAM model, and I mean, new models are being, introduced every single year by the NHAI and other authorities also. The concession agreement would drive accounting treatment. So according to me, the concession agreement would drive accounting treatment here. Now, if the agreement gives you, say, for example, annuity, That's a fixed amount which will be paid on the basis of whatever investment you have made. In that particular case, you use Ind AS 109, it will probably become a financial asset in your books of account. But say, for example, it's a road project and the concession agreement gives you a right to collect the toll. The right to collect the toll becomes an intangible asset. It becomes an intangible asset. So that will have to be recognized as per Ind AS 38. Now, both IFRIC, which is the IFRIC, which is not a part of your Ind AS definitely, but your 115 and Ind AS 38, all these things combine together to say that the agreement would decide if you have got a right to collect toll, for example, a right to mine, for example, meets the definition of an intangible asset as per Ind AS 38, you will have to account it as per Ind AS 38. Many of these agreements are also hybrid agreements. You've got one portion to collect, an annuity or get an annual fee, and also a right for intangible assets, in which case also you'll have to use both those standards. You'll have to use a combination of both Ind AS 109 as well as Ind AS 38. So the agreement will drive the accounting treatments.
Thank you, sir. Thanks a lot. We'll take this 115 later on.
Sure.
Sir, Kaleshwar sir, as regards Ind AS 101, first time adoption of Indian accounting standards, what is the explicit and unreserved statement of compliance with Ind AS we have to be made at the time of first time adoption of Ind AS? And what are the periods which are to be covered in the first financial statements at the time of adoption of Ind AS?
Great, sir. So whenever we talk about first time adoption, I think we have to go back to Ind AS 1, which talk about third balance sheet. So basically, we establish something called as a transition period. So for example, I have adopted Ind AS either on account of a net worth criteria or a listing criteria effective from 1st April 2022. So then invariably I'll have to prepare the last year financials, and that financials have to be in accordance with Ind AS. So I cannot have apple and orange comparison. So I obviously have to redo the last year comparatives in accordance with Ind AS. Now, the transition period is the beginning date of the earlier financial period. So in the given case, if I have adopted Ind AS from 1st April 2022, the transition period would be the beginning date of earlier financial period, which will be 1st April 2021. So that is where I end up preparing a third balance sheet. I'll prepare a third balance sheet to accommodate all the changes on account of a transition as on 1/4/2021 and give effect to other equity, adjust all the and adjust it in other equity. Then continuing the same, I redo the last year comparative financials. The earlier financials might or might not be having this comprehensive income, which is peculiar to Ind AS. So in the comparative financials, I even redo it and take the comprehensive income into account, and that's how I prepare the first time adoption. When I do the first time adoption, this is how I prepare the financial statements. So the set of financial statements would include, in addition to what we disclose, the third balance sheet would come into picture. Now, whenever we are adopting Ind AS, we have to make it very, very clear as to, by way of an unreserved statement, that the transitional element as provided in Ind AS 1 have been complied with. So this unreserved statement have to be provided as a part of basis of preparation in the significant accounting policy, so that the readers of the financial statements clearly understand what are the transition provisions which we have adopted, because few Ind AS 101 do provide for alternatives in case of a transition. So we'll have to make it very clear what are the transition provisions which we have adopted and where we have given effect. So this unreserved statement is a must. There is no question that you have a partial compliances or you have like 60%, 80% compliances. So that is where this unreserved statement saying that you have complied with the Ind AS adoption, Ind AS transition to the full extent. So that unreserved statement have to be given in the significant accounting policy, which is a basis for preparation of financial statements.
Sir, and at the time of first time adoption, we have to give some reconciliations with the previous Ind GAAP, or it could be any other general purpose financial statements. what are the major reconciliation which the entity includes in the first Ind AS financial statements?
So to understand this question, let us go back to the discussion what we were having. So what would be the major difference between the IGAP financial statements and the Ind AS financial statements? So as we said, I basically prepare a third balance sheet on the transition date. And to give effect, I would have arrived at a consolidated effect and I would have given it in other equity. So the first reconciliation, what they want us to do is the reconciliation has to how you have given effect to other equity on the transition date. In the given example, on 1st April 2021, the first reconciliation is to reconciliation giving effect to what are the items which has gone to the equity. The second reconciliation is again in relation to equity, which will be the end of the previous year, because that is where I would have redone the comparative last year financials. In my example, it would be 31st March 2021. I would again prepare another reconciliation in relation to what are the changes I've given it to equity. So in equity, when we are talking, two reconciliation have to be provided. One at the beginning of the earlier financial period, which is basically the transition date, and one at the end of the previous financial year, which is basically 31st March 2021 in our hypothetical example. Now coming to the profit and loss account, see again, I would have read on the last year comparative P&L account. The previous financial statements might or might not have this comprehensive income concept. So the third reconciliation, basically what we have to prepare is in relation to the comprehensive income. What are the adjustments you have basically given in the comprehensive income when we adopted the Ind AS and migrated to Ind AS? So in addition, we also give other reconciliations saying that if at all we have a impairment loss and that is getting reversed, on account of a fair value measurement or other thing. So those reconciliation would be given. But typically these three reconciliation, equity reconciliation on the date of transition and at the date when the last date when the other financial statements were prepared, the financial statements under the old regime were prepared, and the reconciliation statement in relation to comprehensive income. So these are the reconciliation statement which will have to be given, giving what is the sum total of effect or what is the sum total of adjustments what we have given in by giving effect to these three places.
Means for transition date, only the reconciliation of equity, other equity is required.
Yes, sir. So basically, that is what we are talking about. Yes.
Only on the transition date, one reconciliation required of other equity, and for then comprehensive income for the comparative period, and then equity reconciliation for the previous year end.
Yes.
Yeah. Thanks a lot, sir. Sir, in Ind AS non-current assets held for sale or the discontinued operations, what are the basic measurement principle of non-current assets or the disposal groups classified as held for sale?
See, basically, whenever you classify an asset or a group of an asset or an operation as discontinued, that you have to recognize at a carrying value or a fair value less cost to sell, whichever is lower. So basically, you are trying to regroup and reclassify by bringing it down to the fair value less cost to sell or a carrying value, whichever is lower. Okay. Now the question is, if I have done a classification and accordingly have done a measurement with whether carrying value or a fair value less cost to sell, this asset is getting sold, say 1 year down the line or 2 years down the line. So the question is, when I'm ascertaining this cost to sell, I will basically have to arrive at a present value of the cost to sell, and then I will recognize the fair value less cost to sell. With the eventuality of a time, when the time lapses, I may have to pay that additional money because of I have actually accounted it at present value. Now I'm going to pay at a higher sum because of the passage of time. This increase in value, what I'm going to pay, would be recognized as a financial cost in the profit and loss account. So basically, whenever you are going to classify an asset, it will have to be measured at a carrying value, or it would have to be measured at the least of the following: the carrying value or a fair value less cost to sell. And if it proposed to be distributed amongst the owners, then the carrying value less fair value less cost to dispersal. So this is how you will have to arrive at, and the least of it is what you are going to recognize.
And this exercise is to be done at the each reporting year end, reporting period end, because at every reporting period end there can be change in the fair value or the cost to sell.
Yes, we would have actually brought it down. So there could be further instances of that getting reduced, or if at all the scenario reverses, to what extent we can reverse also is been clearly provided in this standard.
Sir, thank you, sir. Mohan sir, now we move into this AS 108 operating segments. So
Yes,
there is a lot of difference between 108 and in AS standard regarding operating segments. There is no concept of CODM in AS. So what are the factors to be considered for identification of CODM in accordance with this requirement of Ind AS 108?
Yes, sir. Again, as you rightly put, the geographical segment, all those things have been done away with now. Though, I mean, they can still be the same, but the way in which segments have been identified has changed significantly in Ind AS 108. Yeah. And again, if you look at the standards, sir, they are very clear. And paragraph 7 says that CODM is not a person with a title. It defines a function. It very clearly says that a CODM is not a person with a title like, CEO or CFO or whatever. Though subsequently they say that the CEO and the CFO can possibly be the CODM also. But they are basically saying that it identifies a function. And I think on a more practical scale, the standard says where resources are being allocated, in which resources have been, who decides how the resources are being allocated. So that would determine what are those segments which have to be identified for the purpose of segment reporting and as per Ind AS 108. Now you can take, for example, how budgets are allocated between various functions and entities. Now this budget could be a group of people, it could be a single person, it could be a committee within the company. They would probably decide, they would probably comprise the CODM. So it is not a person, it could be a group of people, it could be a group of 2 or more people. Basically, they would be the people who would decide how resources are allocated within the company. So resource allocation and the people who decide this resource allocation or how the resource allocation is to be, done. These would this group of people or this person, if it depends on how it works in an individual entity. This would be what would drive a CODMs in Ind AS 108. It can be different. It can be different as compared to AS. It can be different. Definitely, it can be different. Yeah.
Because AS definition of this segment is entirely different from.
Entirely correct.
Kalishwar sir, now moving on to this very, very lengthy topic of Ind AS 109 and Ind AS 32 financial instruments. There definitely we would like to have another. I would request the ASB team to have a separate topic for these kind of standards. But briefly, exactly. I would request you touch upon what consideration affect the classification of financial assets at amortized cost or fair value through OCI or the fair value through profit and loss account.
Yes, sir. For this, I would like to share this PPT. So just let me do this. Yeah. In the interest of time, I will try to touch upon so that
because this topic is very, very lengthy. It requires a separate session. But for the sake of benefit to the users or the participant, I would request to briefly touch upon this topic of financial instruments.
Yes, sir. So the financial instrument standard gives us a methodology or definition as to what is a financial asset and what is a financial liability. And it also gives us a methodology of ascertaining or valuation of this financial assets and liability. So basically, it is called as a business model test or SPPI test, as the case may be. So based on the intent of the management with which it is holding an asset, it could have the following alternative of recognizing the particular financial asset. So basically, the business model are grouped into model 1, model 2, and model 3. So this business model 1 and 2 will have to be tested in an ascending order. That means you'll have to test each of this model in a sequential order. You cannot just directly go to model 2 or model 3. So you'll have to go in a sequential order. So the model 1 is if the intent of the management is to hold the particular asset till maturity, and on the maturity to collect the contractual cash flows. So that means it is purely holding it for the purpose of earning interest and principal or both. That is what SPPS stands for. Then the business model 1 gets established. That means when both the conditions, when you are holding it till maturity and with the intent only to earn the interest for delayed payment or for the maturity or for the principal on the maturity. So it is called as a business model 1. So, and accordingly, you fulfill the business model test, and accordingly, you can recognize this at an amortized cost. This gets recognized at a cost. Now, moving on to the model 2. So it is exactly similar to model 1. The intent of the management is mainly to earn interest and get the principal at the time of maturity, but it will also keep an option open to sell the financial asset only when it is beneficial. So whenever it is open to sell the asset, that is whenever it is like a beneficial, then it is not holding solely for the purpose of principal or interest, but it is also keeping an option open to benefit from the price fluctuation. So that is where the business model 2 comes into picture. So we can have an example of asset management company and those kind of a thing. So for them, the valuation is provided at fair value, which is basically fair value through other comprehensive income. So you will recognize at fair value through other comprehensive income and transfer the difference to other comprehensive income as the case may be. Model 3 is basically the residual category business test, which means it does not fit into either the model 1 or the model 2. So it basically fails the SPPA test. So you can think of investment in shares which are basically for a trading purpose or held for sale and those kind of a thing. So you'll basically do an investment, and as and when you are looking at a price fluctuation, the moment it is beneficial, you will try to sell it. So there is no such concept as investment for the purpose of earning interest. Here, investment would basically to reap the benefit of price fluctuation. So here you have a model of fair value through profit and loss account. So basically you measure it at fair value, and if there is any change in the fair value, the difference will go to the P&L account. So this is a bird's eye view. We again have a option where in model 3 they have a possibility to elect, where if you are having an investment in equity, they have a possibility to elect fair value through OCI, but that once you elect that fair value through OCI, you will not be able to reverse another scenario. So that I would not be touching upon. So this is basically a bird's eye view as to what methodology, measurement principle I'm going to adopt in recognition of a financial asset. I'm going to, based on my business model test, I can choose either the amortized cost or fair value through OCI or a fair value through profit and loss account. Moving on. Yes.
Today we require only the bird's eye view on this topic, because this is a very, very lengthy topic and require a separate webinar on Ind AS 109 and Ind AS 32, AS 32.
Yeah. Moving on to the liability. See, basically, only for the liability which is held for a trading. So that means I have invested, I have a liability which I'm going to trade or I'm going to sell, and that's how I'm going to settle it. So, and the other thing which is like in a case of a business combination, the acquirer company, in addition to the assets and liability, it might even acquire the liability which is not existing on the balance sheet. So basically a contingent liability kind of a scenario, and accordingly it might have to pay for that. So only these two classification of liability, we will adopt this fair value through P&L methodology for recognition. But for these two liabilities, all other liabilities would be recognized at its cost, amortized cost method. So this is basically how you are going to recognize the asset and liability in relation to Ind AS 1, in relation to financial instrument standard. Mohan sir was very, very keen that a particular topic to be covered, which is basically expected credit loss model. I'll cover that and give, and I want Mohan sir to please throw some light onto this. See, basically expected credit loss model for making impairment or making a provision in relation to debtors. So typically what we used to do is we used to follow something called as an incurred loss model, That means we wait for the loss to happen and then accordingly recognize the P&L. So the expected credit loss model is basically on par with the NPA provisioning being followed by the banks and financial institutions. That means we don't wait till the last minute. We basically do a progressive provisioning. The thing is, the moment it says it's a judgmental, the management role becomes very, very crucial. So it has to be determined or established by the management, and there could be a subjective bias. Okay, their management have to. There could be a bias in this, but basically management is expected to have established this provisioning norms, taking the past performance into account. Further, this will be reassessed at each of the reporting period. That doesn't mean that once I make a provision, I don't reassess. I'll be reassessing at each of the provisioning, each of the reporting period. So based on the duration, I basically, based on the factors, I will cover this as, so the debtors would be grouped as stage 1, stage 2, and stage 3. So basically stand similar to, so don't go with the wordings. So I will just put this so that we understand the provisioning requirements of a bank so that we'll be able to relate it. So the stage 1 is basically those debtors which is having a very low risk. The stage 2 is having the debtors which is comparatively of a higher risk. And the stage 3 is basically which is taking sufficient period of time. For the stage 1, we basically take the 12-month expected loss model and then make a provision. For the stage 2, which is still a substandard, there is no doubtful asset, but there is a substandard category where we take into account the lifetime expected credit loss and evaluate the provision to be made. The last is basically the time value of the doubtful category, wherein the percentage of provision what we are going to make in relation to the debtors would be comparatively at a higher rate, taking into account the probable loss for the entire life cycle of the debtors. Mohan sir, request your inputs on this.
Yeah. So thank you, Kaleshwar, for putting that. So Rajesh sir, that was basically on my request only. I told him that
ECL model is to be.
Yeah, though banks have still not moved to Ind AS. When they do move, I think the participants can make out what is going to be the impact on provisioning, because of the fact that you look at this, moving away from the ECL model, the incurred loss model to an expected credit loss model. Incidentally, just for the benefit of the participants here, RBI did bring out a report on the transition to Ind AS, what would be the impact, and they have said that the IRAC norms will be the minimum provision which can be made. But if a bank wants to provide over and above the IRAC norms, they can use the ECL model. If you take the same equivalent for NBFCs, now they are saying that the provisioning will have to be as per ECL model only. There's a mandate that it has to be as per the ECL model only. So it is very, very important that we understand this concept of ECL model. In fact, it becomes a separate exercise by itself to try to develop a proper ECL model. But I think the word called proper and model don't go with each other. They will always, there's no proper model as such. It has to be a model which is, probably justifiable. So the only thing, Kaleshwar, I'd probably add is that for the trade receivables, sir, Rajesh sir, there is something called as provision matrix. So you don't have these stages there. So for trade receivables, you only have to, they say that it should be a lifetime credit loss on the basis of, provision matrix. So the age of the asset would decide the impairment. The more old the asset, it would decide the impairment. So these three stages would not be applicable to a trade receivable. For trade receivables, you will follow the aging schedule on the base, and depending on the aging, you develop a provision matrix. So I think that is what is different from this stage 1, stage 2, stage 3. A specific insertion has been made for trade receivables. That's all. But thank you, Kaleshwar. Thank you so much for providing this.
Thank you, sir.
Thank you. Thank you, sir. Sir, we have running short of time. We have to cover these generally observed non-compliances with Ind AS by FRRB and the NAFRA. I would request Mohan sir to touch upon these two Ind AS in very brief. Ind AS 113 fair value measurement and Ind AS 115 revenue from contact with customers. Only we describe the 3 level of inputs for fair value measurement, and very brief on 5-step model for revenue from contracts with customers.
Thank you, sir. Thank you for easing my task on 115 especially.
Because, sir, we are already at 6:53, and I will take three levels of inputs for fair very briefly.
Yeah. So basically, sir, this it's called as the fair value hierarchy as per Ind AS 113, level 1, level 2, level 3. It goes by the core concept of Ind AS 113, which talks about maximizing the use of observable inputs and minimizing the use of unobservable inputs. This is the core concept of Ind AS 113. So level 1 will be wherein my observable inputs are the maximum. Say, for example, unadjusted quoted market price is a good example of a level 1 hierarchy, wherein it's a quoted market price. There is an active market. So that is an example of a level 1 hierarchy. Level 2 would probably be observable inputs are significant, but they are not 100%. There are a little bit of unobservable inputs also. We'll have to do a little bit of adjustments we'll have to do for that particular. So it's not unadjusted quoted market price. It could be adjusted quoted market price based on similar company share price. So that would be level 2, wherein we are having observable inputs significantly, but they are not entirely observable inputs. Level 3 is basically use of unobservable inputs. This could typically be your valuation reports, because all your DCF technique is not observable. It's just, an estimate being made. So all your DCF valuations, they would fall under level 3. The standard encourages us to use observable inputs. This fair value hierarchy, just for the information of participants, is only for the purpose of disclosure. It does not give you any indication about the quality of the value of the asset. It's only for the purpose of, just because level 3 doesn't mean the value is low. It's only for the purpose of disclosure as per Ind AS 113. That is the fair value hierarchy, using this concept of maximizing the use of observable inputs and minimizing the use of unobservable inputs. As far as 115 is concerned, sir, I think a separate webinar was done. I was a part of the webinar, so I think you don't have to worry too much about 115. But again, this 5-step model, which is becoming very popular. Incidentally, that 5-step has never been mentioned in the standard. Everybody has got used to the 5-step model. Identifying the contract with the customer is the first step. Identifying the performance obligations in the contract, second step. Determining transaction price, third step. Fourth is allocating transaction price to the performance obligations. And the fifth is recognizing revenue when those performance obligations have been performed. Sir, in summary, I think what is very, very important is identifying of performance obligations and when they are going to be performed. The entire essence of Ind AS 115 and performance obligation has been defined to be a promise in a contract which is distinct, or a distinct promise in a contract. And I think during our interaction, sir, we had a specific question on warranty. So I'll just answer that before, this warranty, a very clear guidance given in 115 is that assurance type of warranties, sir, please use Ind AS 37 for making a provision. If there's an assurance type of warranty, we will use Ind AS 37 and make a provision. If there is a service type of warranty, it could be a performance warranty for a long term for the performance of the asset. If it is a service involved warranty which is built into the price, or even if a price has not been built, you can ascertain this using a standalone selling price. It becomes a performance obligation. It will have to be segregated separately, and the performance obligation, those 5 steps would have to be followed for this particular thing. The last portion will be on this non-cash consideration, wherein the standard talks about fair value, and a question which arose during our discussions was, what will happen if the fair value of a non-cash consideration is not ascertainable or is not readily available? Again, here, sir, the standard has got a very nice term called as standalone selling price. It's got a very nice term called as standalone selling price. Even for allocation of a price to the performance obligations or for fair value for a non-monetary consideration, standalone selling price would be used to ascertain what value we have to put for it. Standalone selling price is the price at which you sell to independent third parties. So this is basically the essence of Ind AS 115 and 113.
Sir, now we are nearing the 7 p.m. Timeline. I would request Kalishwar sir to, first of all, because nowadays many penalties are being imposed by NAFRA on the auditors. I would request throw some light on whatever major non-compliances have been observed by NAFRA. And then I would request Mohan sir to throw light on non-compliance observed by FRRB.
Yes.
Yes, so very briefly I will touch upon. So NAFRA has pointed out basically on two aspects. One is 115, Ind AS 115, and the other one is borrowing cost. So in 115, what they're basically saying is the transaction price should be less the variable consideration, which most of us are not following. So basically the transaction price should be the value less the allocated variable consideration. So that is the first aspect of it. So coming to the second aspect of it, while measuring the debtors, few of the entities are measuring them at a fair value, which is considering that as a financial asset, where the NAFRA is stating that it has to be measured at a transaction price. So ideally, how the entities are doing is they will measure it initially at a fair value. Then on the balance sheet date, they will recognize it at amortized cost and then recognize the difference to the P&L account, which is incorrect. So the NAFRA has pointed out that don't recognize this at a fair value, the debtors or the receivable as the case may be. You recognize it at its transaction price. Yeah. So this is the first in relation to 115. The second, in coming to borrowing cost, the background is an entity had become an NPA, and accordingly it stopped making provision in relation to interest, taking a stand that it will get an interest waiver or it will go for a one-time settlement, and accordingly it doesn't have to recognize interest expenses. NAFRA came heavily both on the entity as well as an auditor for not disclosing or not making a provision with respect to the management and not disclosing it on the auditor, stating that your liability would cease only by operation of law or by when the creditor's waives is right. Just because it has become an NPA or just because there is a possibility that one-time settlement, your liability has not crystallized. And accordingly, you are still supposed to make a provision for interest following the expected interest rate model and other thing. Accordingly, they came heavily and suggested that interest on this kind of loans have to be provided for. So these are the 2 points which NAFRA have pointed out. Over to you, Mohan sir.
Yeah, thank you, Kalesh. So,
sir, please elaborate on the non-compliance observed by FRRB.
Yes, sir. Yes, sir. Again, I'll take very, very brief this thing because it has come in 2 volumes. So what I'll do is I will just tell you the numbers, the statistics, because that is, again, for the participants here, it will be very, very useful. And I'll give one example which specifically has been pointed out by, in terms of what the FRRB is being saying. Sir, if you look at the volumes which have been given and the observations that are given, the FRRB has also given us which standard non-compliance is the maximum. And you will be very surprised, sir, that 13% non-compliance in Ind AS 1 itself. 13% non-compliance in Ind AS 1 itself, which I would assume is because of classification. Many of those things are basically for classification errors, but I was really surprised that 13% was Ind AS 1. 11% is for Ind AS 107. Again, here I would like to, though, Kaleshwar did not speak specifically about disclosures of financial instruments because we thought we'd do it separately here. One advice to all the participants here who are auditors is that please understand that the disclosures are specific to the entity. It is not based on another entity's disclosures. Those risks which are there for financial instruments could be anything. Those risks which you are disclosing as per Ind AS 107 are specific to the entity and not template-based disclosures. You can't just use a template for the purpose of these disclosures. So 11%, sir, is for Ind AS 107. 10% for Ind AS 109. I would fully agree with it, considering what Rajesh sir, you also said, and what Kaleshwar has also summarized. Ind AS 109 is not a very simple standard to implement because business model can change. Then they talk within the standard, they talk about so many paragraphs. They say, go back to paragraph number P65, come back to paragraph P number, P35, whatever it may be. A lot of these things have been observed by the, and 7% sir is on Ind AS 8. So I think that basically it also relates to what Kaleshwar was saying about NAFRA and talking about the fact that, accounting policies have to be specific to the entity. I will just give one example so that, in the interest of time. One of the observations made by the FRLB was that ever since one entity has been implementing Ind AS, they have been using this word called provision for diminution in the value of investments. Consistently, they've used the word called provision in the value of investments, diminution in the value of investments. And the observation of the FRLB, sir, was that there is no such word at all in Ind AS when you're using the word called as fair value. So apparently, even though this entity transitioned from AS to Ind AS, they're going back to the AS words. FRLB has made a specific comment saying that you're using AS terms, not Ind AS terms, even though you converted to Ind AS 3 years back. So I think, again, as a general, as I've said earlier also, sir, I think all the participants should go through those summary of those observations. There are some very significant changes which have been made there. And to be on the optimistic side, not too many recognition and measurement problems have been observed. I think most of it has been only about classification, sir. Most of it is only about classification and such errors wherein they are using some terms which have been as per AS and all those things. So thankfully, nothing major has been observed, but there are a lot of classification problems which have been included.
And also the disclosure, I think.
Definitely disclosure. Yes, definitely.
A lot of the observations are there as regards disclosure.
A lot, yeah.
Because for Ind AS, we have to come out of AS.
Exactly. You're right, sir. You put it exactly right. We have to come out of AS. That AS mindset we should come out of.
You have already talked about that provision for diminution in value of investment. There is no such word as if we say fair value.
Correct.
So, sir, we, as regards question answers, I think in ASB should prepare a summary or a very brief summary of non-compliance with the Ind AS as observed by FRRB. Volume 2, nobody is going to go into all the 2 volumes.
Correct.
At least summary of some of the major observations which have a significant impact on the financial statement or disclosures in the financial statement.
Completely agree with you.
We definitely would request Pramod Jain ji to prepare some of the summary so that readers are given a lesser amount of pages for going through the non-compliances.
Otherwise, ChatGPT will do it for you now.
Yes, sir. Yes. So we have 2-3 questions. Can we go through those before we end up?
I think we should wind it up now, so because it's way past 7 o'clock.
We can share
those questions. We'll respond to those questions separately. Record kar do usko.
Okay.
Thank you.
We'll give a response to those questions separately.
Okay. We are already running ahead of time by 6-7 minutes. Sir, I on behalf of ASB, thank a lot to both the learned panelists, CA Mohanji and CA Kaleshwar Prasad ji, for such a detailed and purposeful discussion on various Ind AS to be taken into consideration for the preparation and finalization of financial statement for the financial year 22-23. I think the participants will be immensely benefited with this webinar at the time of finalization of financial statement, because nowadays we are already into the finalization of financial statement for the year 22-23. I thank team ASB for organizing and managing this webinar on an important topic well within this time. I thank CA Pramod Jain ji, Chairman, Accounting Standard Board, in his absentia, and CA Abhay Chajat ji, Vice Chairman, Accounting Standard Board, in his absentia, for keeping the members updated always well within time by organizing these kind of webinars. I thank a lot, and thanks team ASB.
Thank you, sir.
Thank you, sir. Thank you for coordinating this session so well. Thank you, sir.
Thank you.
Thanks, Kaleshwar. Thank you.
Thank you, sir.